Hi everyone, this is Dr. Nitin Chhoda, and in this training video I'm going to talk about the dark side of negative interest rates, because the Federal Reserve Chairman actually said to Congress, do whatever it takes. I'm going to cover 5 things in this training video. The first thing is the history of the federal funds rate, because the Federal Reserve meets 8 times a year to set the federal funds rate. The second is the low savings rate in America, why we as Americans are hardwired to be spenders and not savers, and I'll show you some statistics that'll surprise you. Number 3 is I'll talk about what the president wants. You're probably aware of what the president wants, but I'll just show you some information which makes his position clear. Number 4, I'll talk about what the Federal Reserve Chairman has said and whether it's likely that we have negative interest rates. And number 5, I'll talk about what this means to you. If you're an existing subscriber, welcome back to my channel. If you're not a subscriber yet, please consider subscribing below and please smash the notification button so you get an instant update. Also, please click the like button so that it can reward creators like me, and it really does help the YouTube algorithm. I would really appreciate it if you can just take a second of your time to do that. So with that being said, let's get right into it. So let's talk about the history of the federal funds rate. Now, I talked about this in a previous video where our government consists of a central government, which essentially collects money, which spends money, which sets policy, which sets up coordination with foreign governments, and a central bank. The job of the central bank originally, when they were set up, was to control the amount of cash in the economy and was to control credit in the economy. Now, the Federal Reserve, which is the central bank, they do that by printing money, they do that by controlling interest rates. But over the years, the job of the Federal Reserve has actually evolved. So again, the Federal Reserve, also known as the Fed or the Central Bank of the United States, they were actually created back in December of 1913, and the primary mandate of the Fed was to maximize employment, stabilize prices, and moderate long-term interest rates. Now, over the years, there have been many crises. As you probably know, there was a Great Depression in the 1930s, which was really the first big problem that the Fed had to deal with. More recently, we had 9/11, and then we had the mortgage subprime crisis in 2008, and now in 2020 we have the pandemic crisis. So this has forced the Fed to step in and do all sorts of things that they were not originally designed to do, because there's essentially been one crisis after another. So that's what's been going on. So there's been an expansion of the roles and responsibilities of the Fed, and more recently, the Fed has started supervising and regulating banks. The Fed has been trying to maintain the stability of the financial system with all these worldwide shocks that have been happening, and also providing financial services to depository institutions, the US government, and foreign banks, because foreign banks actually rely on the US Fed for monetary policy and for cash flow, because the US dollar is the reserve currency of the world. Now, what does all of this mean to us, the average person, my viewers watching in the channel? The Federal Reserve meets 8 times a year. The board of the Federal Reserve, they meet 8 times a year to decide what's called as the federal funds rate. So the federal funds rate is it's the interest rate at which one bank can lend money to another bank. So think of it this way: when the federal funds rate is high, you're paying more for a mortgage. You're paying more for a car loan. You're paying pretty much more on any kind of loan that you take out, whether you're a business or a consumer. When the federal funds rate is low, and by the way, at the time I'm recording this video training, the federal funds rate is 0.05%. It's almost at zero, and there have been talks of potentially it going negative. I'll talk to you about whether that's likely at the end of this video. Not by a long shot, not in my opinion. So as far as the federal funds rate is concerned, I'm going to show you a chart of the fluctuation in the federal funds rate from the year 2000 to 2010, and then I'll show you another chart that shows the fluctuation in the federal funds rate from 2010 up to 2020, the most dramatic shift in the federal funds rate. It's been so dramatic in the past few weeks that the chart I'm about to show you wasn't even able to take that into consideration because the move was so massive. This just gives you a sense of the situation we're in, the unprecedented nature of the times we are in right now. Let's start with a review of what happened with the federal funds rate from the year 2000 to 2010. I'll start with June 2000, and now for all of you who are aware of the history of what's happened financially in the last 20 years, you know about the dot-com bubble and there was a recession in 2000 and there was a dot-com bubble in 2001. In response to that, and you can see the screen right here, the Federal Reserve changed the federal funds rate from about 6% all the way down. It kept going down October 2001 all the way down in 2003 to about 1%. Then it went back up gradually in 2007, and then with the subprime crisis, it fell back down dramatically in an effort to rejuvenate the economy back to right about where it is right now. Quite incredible. You'll see that the Federal Reserve has essentially been trying to change policy in order to make sure the economy keeps functioning, in order to make sure the economy keeps growing. Quite incredible what they're doing, and if you're a student of history, you'll see that many times history does indeed repeat itself. Now let's look at the graph from the year 2010 to where we are now in 2020. So the period from 2010 to right about 2016 was where the economy was recovering, and in 2016 when the Fed said, yeah, things are getting better, let's start raising the interest rate. So they kept raising it all the way up to about 2.4% in June of 2019, and then they dropped it a little bit. And now this graph, by the way, ends February 10th, 2020 at 1.58%. What has happened since February of 2020, which by the way is where this graph ends, when we got hit with this pandemic. At the time I'm recording this video training, it is May of 2020. In the past 2 or 3 months, the federal funds rate has fallen from 1.58% all the way down to 0.05%. So if you compare this chart with what happened in the past 10 years, these things always go up slowly, always come down slowly. But there's been a dramatic fall, there's been a dramatic correction from the Federal Reserve to bring the federal funds rate down to 0.05%. In fact, it's so dramatic, it's not on this chart that you see. The last thing that you see on this chart is 1.58% on the 10th of February 2020. Now in the middle of May 2020, that rate, imagine that line going straight down, is at 0.05%. What does all of this mean? This means that the situation has been so dramatic and the action taken by the Fed has been so unprecedented, which by the way, I give them a lot of credit for. I think it's incredible. I think they are doing phenomenal work. And I'll tell you again what this means for you in our day-to-day lives. But what they've done is make it less expensive to borrow money. They are trying to increase liquidity. They're trying to make sure that more money they're trying to make sure that banks can now easily lend money, because it is the lending of that money that's going to lead to more purchases, that's going to lead to a rejuvenation of the economy. Because ultimately, I believe that you, my viewer watching, you are the solution to this crisis. When you start buying, when you get out there, when you go to a restaurant, if you start to travel, if you get another car, if you buy stuff, if you do home renovations, if you hire employees, if you're a small business, that is what rejuvenates the economy. And with the interest rate being so low, it is supposed to be easier for us to borrow money. Now, I talked about this in a previous training video. We are at this unusual juncture in our economy, in our history, where on the one hand the interest rate is low, but on the other hand banks are nervous, banks are scared to actually lend money because they don't know if you'll be able to pay them back. Now, why would someone lend you money if they weren't sure that you were going to pay them back? Which, by the way, is one of the reasons why the central bank has lowered the federal funds rate so much, and the central government is trying to work on more stimulus to the everyday American. Because on the one hand, the central bank wants to say to all the other banks, Bank of America, Wells Fargo, Chase, all the credit unions that you work with, hey, go ahead, lend the money. And then those banks are now thinking, wait a minute, how do I make money? Because now ask yourself, how does a bank actually make money? A bank makes money primarily by borrowing money at a low interest rate and then giving it to you or someone else, whether it's you as a consumer or you as a business, at a higher interest rate. So if I as a bank, if I can borrow money at 0.05%, which is, I mean, that's nothing. It's like you're just taking the money and not paying interest on it. And now if I can charge you as a consumer 10%, 15%, 20%, 25% on your late credit card bills. If I can give you a car loan and I can charge you 2, 3, 4, 5%. If I can give you a mortgage and I can charge you 3, 4%, I actually make that difference and that becomes my income. Not to mention all the fees banks charge, all the initiation fees, all the loan origination fees, all the other miscellaneous fees that are thrown in by banks, late fees, finance charges, penalties. That's how banks make money. So in this particular scenario, because interest rates are so low, banks should theoretically either start offering you money at low interest rates so that you can borrow more money, or if for whatever reason they can't do that, they'll start charging high fees. In fact, if interest rates go negative, the only way for a bank to make money is to charge you fees, and the banks are going to start charging you more and more fees. So that's really where the gray area comes in with negative interest rates in the future. Now, I've talked about negative interest rates, but I think paying attention to the savings rates in our country is also very important. If you take a look at this chart on your screen, you'll see that over the past several years, back from 2015 all the way to 2020, our savings rate has been anywhere between 6% to about 8%. Now it seems to have gone high recently up to 13.1%, but that's not because we are saving more. It's simply because we're spending less, which by the way leads to a contraction of the economy, which is not what anybody wants. The US government doesn't want that. The world doesn't want that. The world needs all citizens, especially us Americans, to consume more, to spend more, because then we buy stuff that's made in other countries. There is an argument to be made about negative interest rates, because that actually makes the US dollar more competitive with the global economy, so that when goods are made in the US, they become less expensive for other countries to purchase, especially if you want more and more goods to be made in the US, which I know is a focus of the current administration. Now, let's compare our savings rate with the savings rate of another country like Switzerland, for example. By the way, Switzerland is one of the 5 countries in the world that does have negative interest rates. Now, this is interesting. The average savings rate in Switzerland is right around 13-14%. This tells you that the Swiss save money at twice as many Swiss save money. They are savers as compared to Americans. So, by the way, this was one of the reasons that Switzerland instituted a negative interest rate, because they don't want their citizens to just keep their money in a bank. They want their citizens to go out there and spend, because with a negative interest rate, you don't get paid for keeping money in a bank, you get charged money for putting your money in a bank. Now, in case you're worrying that, oh my God, do I put my money in a bank and is the bank going to charge me? I don't believe negative interest rates will happen in the US for 2 big reasons. Number one, we are fundamentally spenders. If you look at that chart I mentioned earlier, our savings rate is quite low compared to other countries in the world, right around 7%. So we are hardwired to be spenders. It is in the DNA of an American consumer to spend and to live on debt and to live on credit. Again, when done responsibly, this is not a bad thing. If you're saying, oh, we should stop all credit, that's not how things work. In fact, that would lead to a collapse of the US economy. That would lead to a significant contraction of the US economy. We would not be able to drive the world's economy and buy stuff from all over the world if all we did was we had cash transactions. A lot of countries are actually trying to move towards a system like the US and have more credit, as long as it's responsible. I think the US credit system is a good system if it's used responsibly. So again, back to the 2 reasons why I think negative interest rates won't happen. Number one, we don't need negative interest rates because we are spenders. When given the incentive to spend, when given money, which is where all these stimulus checks are coming in, and when given low interest rates, we will respond by spending more, because our behavior, our human emotion is essentially to consume and to spend. That's how we are. Now, the second reason why I don't think we'll see negative interest rates in our country is a majority of Americans are low to middle income. Now, imagine if you were making $2,000 a month and you put your money in a bank and the bank charged you money for putting money in the bank account as opposed to paying you interest, because that's what negative interest rates mean. You would not put your money in the bank. You would say, I'm just keeping the money in cash at home. Banks don't want that. Banks want you to deposit your money with them. The only real impact to negative interest rates would happen to those who have hundreds of millions, potentially billions of dollars, because they now would be charged some amount of money by big banks to have all of their money in those bank accounts. I think for us, for average Americans, for the low wage earners, for middle income Americans, what you're likely to see is low interest rates for car loans. You're likely to see low mortgage rates. You're likely to hopefully see lower interest rates on your credit card bills. All of this should boost the economy and should boost spending, which finally is the idea behind low interest rates and negative interest rates. So I don't think we are likely to see negative interest rates, not by a long shot. By the way, it's very clear that the president wants negative interest rates. Here's an article on NBC News, and the headline of the article reads, Trump wants negative rates, but what would that mean for your wallet? I'm going to scroll down and show you one of the tweets from President Trump, and his tweet reads as follows: as long as other countries are receiving the benefits of negative rates, and by the way, there are 5 countries in the world that do this, the USA should also accept the gift. He calls it a gift. Big numbers. This was a tweet from President Trump. Now, David Lebowitz, a global market strategist at JP Morgan Asset Management, does not share the president's sentiment. He said there is little, if any, evidence that negative rates actually stimulate growth, inflation, or improve bank lending. Also, Greg McBride, the chief financial analyst at bankrate.com, said negative interest rates won't filter down to the consumer level. No one is going to pay you to take out a loan, and banks will not charge money to put in a savings account. So what does the Federal Reserve Chairman Jerome Powell think about all this? In this article in the New York Times, the Federal Reserve Chairman said to Congress, do whatever it takes to keep the economy from collapse. His exact words were, this is the time to use the great fiscal power of the United States to do what we can to support the economy and try to get through this with as little damage to the longer run productive capacity of the economy as possible. He also said, those are going to be key policies that will come with a hefty price tag, but we would come out of this eventually with a stronger economy and with less long-run damage to the economy. In fact, the Federal Reserve has specifically said that they are not interested in negative interest rates at the moment, and they do have other tools in their toolbox to try and combat this if the recession continues or if the economy starts to get worse. And finally, this is one of the best articles I've read on low interest rates. I'll link to this in the description below. The headline reads, dealing with the dark side of low interest rates. When you borrow, low interest rates are fabulous, but if you need to live on your savings, you'll be receiving far less income. So far in this training video, I've covered the history of the federal funds rate, the low savings rate in America, what the president wants, what the Federal Reserve Chairman has said, and finally, let's get into what this means for you and what the bottom line is about the negative aspect, about the dark side of negative interest rates. Before I get into that, one more time, if you are a member of our community, welcome back. If not, please consider subscribing so you get important economic updates like this that affect your financial health. Please also click that little bell icon, the notification button, so you get an instant update as soon as I release a video. And also please click the like button, because that does help out the YouTube algorithm. So here's the dark side of negative interest rates. On the one hand, it is a good thing if you're borrowing money, because you can get a car loan at a low rate, you can get a mortgage at a low rate, you can probably refinance your existing mortgage at historically low rates, because I believe that low interest rates are here to stay. I believe that the interest rates will remain low for at least a couple of years, potentially even longer, until we make our way out of this downturn. If you look at what happened back during the subprime mortgage crisis in 2008, the interest rates remained low for several years, and then they started going up gradually in 2016. I actually showed you a chart about that earlier in this video training. So I do believe low interest rates are here to stay. Now here's the dark side of negative interest rates. If you're just approaching retirement, and if you need that money, if you've been a saver all your life, and if you have that small nest egg and you're really looking to rely on that for your retirement, you've got 3 choices. One is you live on less. Number 2, you take some risky bets in the stock market. Or number 3, you dig deeper into your savings. These are horrible choices. Imagine having to live on less and cut corners. Imagine having to dig deeper into your savings and ask yourself, I'm not sure if I'll have enough money to get through my retirement. Or worse yet, now because you're barely getting any interest off of your savings account, off of all the other accounts that you have your money in, now you tell yourself, am I going to take some risks in the stock market? And you definitely don't want to take risks in the stock market during your retirement years. In fact, it is my personal belief that the stock market is pretty high right now, even though it's gone through its ups and downs. I personally am not investing in the stock market at the time I'm recording this. I did do another video training. You can go back to one of our playlists and look at the video training on what's likely to happen to the Dow Jones based on my analysis of Warren Buffett's most recent investor meeting. I think it was phenomenal what Warren Buffett said and did not say. In short, I don't think I'm investing in the stock market, and I'm not sure if others should either. So again, the negative side, the dark side of negative interest rates is if you've been responsible, if you've been a saver all your life, and now you have that little nest egg, you're now stuck because you either live on less, you make do with less money, less resources, you take more risks in the stock market, or you dig deeper into your savings. None of them are good choices. This is the dark side of negative interest rates, because it actually hurts those of us who've been fiscally responsible, who've been financially prudent, who've been very well organized all their life, and now are heading into their retirement expecting to make at least 3%, 4%, 5% during their retirement years. It's not going to be possible because the federal funds rate is now so low, and that impacts the rest of the financial system. Thank you so much for watching, everyone. I promise you we'll get through this. If you're not a subscriber yet, please click the subscribe button. Please smash that notifications button, that bell icon, so you get an instant update as soon as I release a video training. And please click the like button, because it does help out the YouTube algorithm, and I would really appreciate it because it helps creators like me. Thank you so much. I'll see you in the next training video. Take care.